So the first thing we kind of want to talk about is some of the benefits and the benefits of home ownership and the importance of owning a home, and then some of the misconceptions that some buyers may have about purchasing their first home. And we'll start with you, Akenna.
Well, I think some of the benefits of home ownership is, one, like we discussed, it is a wealth aspect for yourself, but it's also a way of leaving an inheritance for other people, for your children, anyone else you'd want to do. It's a way to grow equity. And I don't want to go into too many of the next questions, but home ownership brings a lot of value when it comes to stabilization, because whether we're in the Raleigh regional area or we're in the Charlotte area, Greensboro, the relocation coming down to the south or over to the southeast side is tremendous. And that means a lot of growth, relocation, which means our values due to shortages is going up more and more. So your value in your property will appreciate significantly right now at this time period. So it's a great opportunity to not just pay someone else's mortgage, but to pay your own mortgage and to build that equity and that profitability for yourself.
Yeah, and just to piggyback off that, there's a lot of advantages, home ownership, some being like mentioned, the equity and appreciation, but also there's tax advantages for owning a home. There's the freedom and flexibility to renovate. It's your home. You can do whatever you want. And you could use, if you're in the investment mindset, you could use it as collateral, or you can use it as a rental, Airbnb. So, owning definitely gives you that instability. So you're paying the same mortgage for 30 years, you're paying the same payments. So there's a lot of advantages to home ownership.
Calvin, did you have anything you want to add?
Yeah, I'm just tapping into kind of equity. I know the next point we have on the agenda here is how home ownership, or the advantage of home ownership, can go into equity and how we can ride equity up into buying a property. So I stated before that I kind of came up owning a few rental properties, and found that out to be really lucrative. The main point of actually being in the home and living in the property is, just by you living your everyday life, you are paying down the principal into your home. And by paying the principal into your home, you're creating equity. So when you're going to the bank and getting a loan to purchase your property, that bank is saying, okay, you have a monthly payment every month to take care of this property, or to pay the bank back for their loan to you. But out of that payment that you're making every month, some of that is going to be going to your taxes and to your insurance and to the interest you owe back to the bank. But a small portion of that is going to the principal. So it's going directly to the amount that you borrow from the bank. And while you're in your home, just living your regular day life and paying your principal over time, you're, as Akenna and Joe said, your property is hopefully, in this market like this, appreciating at the same time. So you're kind of like, double dipping, if you will, into the profits. You're knocking money down while you're staying in there. And you're also watching your property rise up, and going to be able to take advantage. Specifically, if you stay in that property 2 years or more, you're going to be able to sell it, and whatever profits you make, it's also some tax advantages there, to where you're not going to have to pay taxes on that profit. It's one of the only ways to avoid paying taxes on a large lump sum of money. And they're still trying to dig into it, but that's the beauty of it. Joe just said, like, home ownership is kind of protected, if you will. One of those things. Yeah, baby. Yeah. Uh-oh.
What's up?
Sandrine, can you go on mute, please? Go ahead, Calvin.
Oh, no, that was pretty much all. That was all. I kind of got thrown off, but.
If I can add just one other thing, one of the best benefits for me, knowing that I own my own business, has always been to write off some of the expenses of having a home office. And that is a tax thing that Joe was alluding to as well. You can have a Mary Kay home business or any other type of home business, and you're able to write off a portion of that space that you're using in the property, as well as the expenses associated with that area. So plus purchasing your first home as an owner occupant gives you the better financing type if you're doing a loan on that product. So if you're able to do all of that and get the better financing, that could be your first investment. Is that me? No, it's not.
Oh, okay. Okay. But yeah, so Thank you. I think that kind of ties in, especially for individuals that have owned homes before the pandemic started. I think they're seeing a lot of appreciation in their home values and getting a lot of equity that they're able to use now during the pandemic. And that's one thing that a lot of us have not taken advantage of by not owning homes. So that's something that I think moving forward, we want to make sure everyone has the tools and information to be able to take advantage of. Yeah, that's weird. I don't know. But so since all of you are real estate agents and have worked with clients, what are some of the excuses or things that you may have heard that have prevented some people from moving forward from buying a home that maybe shouldn't be preventing individuals just because of things they heard, or they just have a false sense of what they need to do in order to get into a home?
Some people are just afraid of the responsibility. I've worked with one of my first time homebuyer clients. That I had was a 75-year-old couple who had rented the same house for over 30 years. And they were just afraid of a maintenance situation that may pop up and say, well, I don't really want to take care of that. They'd rather pick up a phone and call the landlord to handle it. They think it can be overwhelming with expenses. When in doubt, if you prepare like anything else in life, it really is not. And some people think that, well, it's all going to fall apart, or the financing, because we have been victims of subprime financing as African Americans or minorities. So they're afraid of that mortgage payment and the issues behind that. So you get all kinds of reasons why people aren't ready to move into home ownership.
Yep. Anything else to add to that? All right. So then moving on to having individuals prepare to purchase a home, right? So what would someone need to do to put themselves in position to purchase a home? What are some of the steps they need to take? And I'll start with you, Joe.
Shut the fuck up!
So basically, the steps in just buying a home, do you want me to give you like the process, or how do you want me? Okay, so I give you a very high level overview of buying a home and what it takes to buy a home in North Carolina. So the first step is identifying that you want a home, your needs and your wants in the home. Getting pre-approved would be the next step in the home buying process. The first step essentially in the home buying process. Talking to your lender, anyone that's that you bank with, start out there, or recommendations from a realtor would be great. Getting a pre-approval from a lender. Once you've gotten that, you kind of get the financial picture of how much you can be pre-approved for, and then give you an estimate of what your monthly payments would look like. So once you kind of get an idea of that, you want to search the market, use a realtor, one of us or a friend, or get some recommendations. And what a realtor it will help you do is find homes that are in your criteria. So you tell them what you want, what you're looking for. And then after that, you want to select or once you've viewed the market, they send you, emails and all that, then you want to select a home. So once you find a home that you like, you go see it, you put an offer. Realtor will help you put an offer. And this is just a legal document that all realtors have, and we walk you through that process. The offer consists of many things, but the three most important things is the offer price, how much you're willing to pay for the home, your due diligence amount, which is high level, which is an amount that you give a seller as in return for taking the home off the market. Earnest money, down payment of how much you're going to put down or show that you're going to put down home. You also want to put a settlement date, what you're closing, when you would like to close. Once you've kind of got your offer composed with the help of your realtor, you submit that offer to the seller. And once the seller reviews it, they can come back with a counter offer, or they can accept your offer. Once they accept your offer, you're under contract. Once you're under contract, that house is contingently yours, pending any inspections. And so once you're under contract, that's when you want to do your due diligence. That's when you want to do your home inspections. You get a licensed professional home inspector to check out the house inside and out, and you'll get everything that they found in a home inspection report. Once you've gotten that report, then you have an idea of what, as far as maintenance of the home, what's going to need to be fixed either now or later. From there, you could probably negotiate with the seller a little bit for some items to repair or things to be paid for or credited for at closing, just depending on how you negotiate, you and your realtor. Your buyer agent will help you negotiate, any repairs. And then once both parties have agreed to whatever repairs or none, North Carolina, unfortunately, is a buyer beware state where sellers are not obligated to make any repairs, unfortunately. But, if you have a good realtor that can negotiate, you could probably get some repairs done. Once you've kind of gotten that negotiated, then you wait for the final walkthrough. During this time, this is when your loan is going to get underwritten. And from there, the loan officer would, need more documents. So once you provide more of the financial documents that they're asked, as well as wait for the closing date that you stated in your offer, you have a final walkthrough the day of closing. Final walkthrough is just making sure that the house is at the same condition or better than you last saw it. Or if you made any repairs or agreed to repairs, they were done. And so once the final walkthrough, everything checks out, everything's good. The seller has moved all their belongings out the house, and this is the house that you will be moving in the day of. You go to closing and close on the home with the attorney and the closing attorney. And that's where you would sign all the documents that the closing attorney has prepared for you. So that is a whole bunch of steps in buying a home. But if you're at square one where you have the idea or you have the thought in your mind that you want to buy a home this year, next year, even 2 years from now, the best logical next step would be talking to a lender and figuring out your financial picture, because that is very important and that's required to start your home search.
Okay.
Yeah, if I can add anything, okay, I don't mean to jump in there too. The first step we all need to focus on and always pay attention to, just like we've been hacked with the noise coming on here, people are always trying to hack our financial situations, but you need to go to annualcreditreport.com and pull down your credit report from all three bureaus, TransUnion, Equifax, and Experian, so you can see what is on your report card to the world and get that free credit report of all three agencies or bureaus, then start there. So if you know that you've gotten all of your payments and stuff of your accounts are on time, then you know where your credit score is too, because you can purchase your credit score through that same platform. But that's your first start. Know where you are financially, know how much you're comfortable with paying monthly for a mortgage. And know that when you communicate to an agent or to a lender, what you want to pay per month should include a fixed rate. It should include all the taxes and insurances and everything that Joe was talking about, so that your monthly payment is clear to you as well as to what the lender is interpreting through your credit report and qualification. That's
a great point.
Yeah.
And when you talk about speaking to your lender and kind of understanding what you can afford, I know that the term DTI, debt-to-income ratio, gets thrown out there a lot. And I know sometimes it can get a little daunting trying to understand, what does that mean? How do I figure this out? So if we can kind of talk about or explain what the debt-to-income ratio is, I'll go to Calvin.
All right, I was gonna actually just go into debt period, because it actually kind of ties into a question you asked earlier. What's something that prevents home ownership most likely? And I see a lot in my clients. So a lot of my clients are mid-20s, early 30s, and we've accumulated some debt. We're out of school. We're living our adult lives now, and the first thing we do is go out there and get an apartment or get our car fresh out of school, our new job. We just accumulate debt naturally. We still have the college loans that we're dealing with. And I think that it's just kind of overwhelming lots of times that we put priorities in our head and say, okay, I need to have all this debt paid off before I move forward with the home purchase. To your point, debt to income ratios are very, very important. And that's when the bank is looking up the ratio of how much you have to pay a month when you talk about all of your bills, bills like car payments, bills like college loans, bills like your new mortgage payment. And then we look at that versus how much money you make on a monthly basis. To give us a ratio, and we have to look at that ratio. It has to be a certain number for you to get approved to purchase a home. I always sit down with my clients, and Akenna just said, like, I tell them to go on creditreport.com or get their credit report pulled so we can see what all debt is out there, and then we prioritize that debt. One of my biggest misconceptions, or that I've came across in my 4 years of being an actual agent, is I have my clients come and they say, you know what, Cal, like, I want to pay this credit card off before I move forward. That credit card might have a minimum payment on it of $100 a month or something like that, okay? And they owe $4,000 on the credit card. So they're thinking, okay, I just need to pay this $4,000 off on this card, and this is going to help me to home ownership. But they have a car payment that might be $400 a month, okay? And they owe, let's say, 3 or 4 more months on the car payment. Like, they just don't want to pay the car off just because we're used to paying that car on a monthly payment. We're not used to paying credit cards off like overnight, and we're especially not used to paying cars off overnight. But that car having a $400 a month on your debt to income ratios versus that credit card having $100 a month on your debt to income ratios, where the car is affecting you 4 times the amount. And in that example, let's say you had $2,000 left to pay on that car and a $3,000 credit card. Even though you have a $3,000 credit card, we often look at the total number and not the monthly payment. And we try to prioritize which one we want to pay. We naturally pay the higher number, the higher total. But in this example, it'd be really smart to pay off our car so we can free up $400 a month on our debt to income ratios, which is going to have 4 times the buying power as paying that same credit card off. So really understanding debt and not letting debt be an excuse, and really understanding low-hanging fruit. So if you have like that credit card from Express that you had 2 years ago and you put a suit on that you never paid off, or that Best Buy credit card, you just bought that new TV and you've been paying it off month to month. It's really understanding like the low-hanging fruit, let me knocking all that out, and then seeing how much buying power that's going to give me when I actually go sit down with the lender or with the real estate agent. And again, you can find all that out if you just run your credit report. I think it's just good knowledge to have, like, to you to see your low-hanging fruit and just to go ahead and pay your debt off. Not saying you need to be debt-free to buy a home. Very important though to kind of balance it out, pay a little bit of debt, but also ride that appreciation up with the property.
Yep. Good point. And then also just kind of piggybacking off of debt, right? I know sometimes buyers, once you get a house under contract and you're going through the process and you think you're about to get to that finish line, you've been pre-approved and you're about to get that final approval, and then they go out and then buy a car, right, before they close, or they put a large purchase on their credit card or something like that. That's the ultimate no-no, right? When you're dealing with purchasing a house, right? Because that also affects your debt to income ratio when they go to underwriting to get your final approval, to what Calvin's point was saying. So one thing that you don't want to do, if you haven't heard before, is when you're going through that home buying process, is to not make another large purchase, acquiring debt before you close.
Yes, because they pull credit up to the point of signing documents at the closing table. The lenders do, to verify that you don't have any other open lines of credit. So that's very important to keep things clean and simple. I've had people who have lost jobs and haven't told us about it 2 weeks from closing, and they think that the lenders will not verify all of that. They will verify everything up to the day of closing.
So going into, I guess, the money that you need, or the cost to purchase, right? So I know a lot of times what gets scary is the down payment cost, or you may not have an understanding of what the closing cost is. So what are the costs associated with purchasing a home? And we'll start with you, Akenna.
Okay. Generally speaking, you start spending money as soon as you go under contract. And the general cost coming into a contract is your down payment that you have to think about. the money going into the contract, it's a lot of detail to it, but it's the due diligence money that you're going to be writing as part of the contract. It's going to be also the earnest money that you put down. That shows your interest in how much you want to purchase that property. And it also buys you time to do assessments on that property and determine if you want to go through with it. After you get under contract, you immediately start making purchases of an inspection, which is generally in our market, roughly $400, depending on the size of the house, to $500 for an inspection. A wood destroying insect, which is a termite inspection, is roughly around $80 to $90, depending on who the person is doing it. You also have an appraisal report, and that's generally $500 to $600, depending on who the lender is. As you go through the transaction, and at that point, if you decided that you want to move forward with that property, at the closing table, you're also going to have some other expenses. But let's say you got to that point and you did inspections and you found out there's things were wrong with the house, and the seller had said, well, I'm not going to fix anything. If you walk away from the transaction, the only thing you're going to get your earnest money back is your earnest money if you're within a so-called due diligence timeframe. So I know we can go into a lot of details about this purchase, but depending on your financing, the overall picture is if you're going to do an FHA loan, you're generally looking at putting down 3.5% of the sales price. If you're going to do a conventional loan, you're generally going to put down 5% of the sales price. That's why it's so key that you have a person that knows from a real estate perspective how to connect you with the right lenders, because the loan, you're actually purchasing the loan to buy the house. And that's where your closing cost comes in, because that associates with your credit report, that associates with your origination fee, your appraisal fee, your title search, your title insurance. There are so many details in that line item that come under closing costs and prepaids. And we used to have it when it was more of a buyer's market where we could get those costs paid by a seller, but the market is so strong and in the favor of a seller that they don't want to pay concessions on behalf of a buyer. So that's where, you know, looking at all these numbers, you'll be glazed over like a deer in headlights when we start just throwing out numbers at you. But the biggest point is having a lender statement from that loan officer that breaks down every single line item of an estimated amount you're going to have to pay out of pocket. Because here in our market, if you're buying a house at around $250,000, you need to have at minimum $5,000 just to get started with the offers, because you're going to be putting down that due diligence money and you're going to be putting down that earnest money. And then you've got to pay for the inspection, the wood destroying insect, the appraisal. All those things are coming out of pocket before you close. And then the closing costs and prepaids, that's where the rest of it will be paid out at closing, just like the rest of your down payment. I feel like that was just a lot.
Yep. But good information. Good information. Calvin, Joe, did you guys have anything to add to that? Are you good?
I think you kind of hit it.
Yeah.
Cool.
Head perfect.
Well,
right.
guys, thank you. I appreciate that.
We broke it all the way down.
So I know that you guys, or you mentioned FHA, conventional, but are there any other programs or loan products that buyers can take advantage of to help them purchase a home? So I know we don't have any lenders on the call right now, so we'll try to provide as much information that we have or that we can come with. But are there any other programs, products that buyers can take advantage of if they don't want to go the FHA or the 5% conventional route?
You guys want to start?
Yeah, I'll take a hack at it.
Yeah.
There are definitely, especially specifically in the past couple of years, there've been a lot of first-time homebuyer programs, Adrian. But as we've seen with COVID kind of hitting down, some of the banks' policies have really heightened up, and a lot of these programs are either they're being honored or they're not being honored altogether. I've actually had clients who are using the program, be under contract. We get up into the week of closing, and it's starting to fall apart because of the program changed the guidelines or changed the rules. It is no rules to the program's rules, if you will. So they can say your credit score has to be a 670, and then you start off and everything's rolling. You know, you're about to go to closing, and they set up now the minimum is a 680, and you're at a 675, and now you're no longer eligible for that loan, even though you've done everything up until the point. So a lot of banks honestly aren't even honoring those programs now until COVID kind of lifts up and we kind of get back to some ease. Now, some are, I know state employees, that's one of the first one that comes out of my mind. If you want to get around having to have that down payment money and or all the closing costs, I know state employees has a program that allows you to bring 0% to the table. It is a 5-year ARM rate program. So it's very important that you understand what ARM is versus what fixed is. Fixed mortgage being that you're going to be paying the same payment over the 30-year life of the loan. The ARM saying it's adjustable, meaning, you know, it can change on you. If you get a 5-year ARM, the first 5 years are going to be fixed. So your payment is $1,300 a month. But in 5 years, in 2026, they can come in and say, okay, your payment is not $1,300 anymore, it's $1,800. And you're going to be responsible for that payment. The adjustable rate mortgage allows you to kind of take advantage and get in at a lower payment a month, but overall you always want to choose fixed if you can afford to do so. It's a much safer route, a much safer loan, and it just kind of sets you up. You get used to it. We all want to be better or be at a better place in 30 years than we are today. So if you can imagine, if you're 25 years old, you're opening up a mortgage payment of $1,500. Well, if you're 55 years old, you're hoping to make double your income, or you got side jobs, you've blown your business up, and you still got that same $1,500 mortgage payment. It's much easier to take in that into equation versus an ARM rate that can adjust and really jump up there on you. The only other thing I would say with first time or with programs that I know of,
make a uniform. I'm sorry, did I lose?
No, we still hear you.
Okay, thank you. Just always remember that no money is free money. It is going to cost you in your rate. If you're not bringing the money yourself to the table for your down payment, the lender looks like they will put it in the rate because of the more risk that is there. However, there are some down payment programs, and I loved how you stated, Calvin, things changed, because some of these down payment options are pools of money and they run out quickly. I've had transactions that get close to closing because we did new construction. By the time the house was finished, the pool of down payment money was run out. So we have to pay very close attention to those things. State employees does have a lot more flexibility for people who are members of the organization. However, that adjustable rate is the challenge when we are at lifetime lows of interest rate. I remember having a 6% adjustable rate mortgage, and it went up 1%, and my payment went up like $1,000 almost. I felt it for 1 month, but that was back in the day when the recession was hitting in 2007 and 8. But there are down payment programs depending on your credit score. That's why I say be empowered for yourself. Go to annualcreditreport.com and look at where you stand, because the better your credit score is, the less your mortgage insurance is going to be, and the better your rate will be. So that's how you're able to save money. Get with someone who can give you good advice and not just put you in a loan or try to put you in a house. Research those people. As far as down payment monies, North Carolina Housing Finance is all over North Carolina. They have a CPLP program where you can get $40,000 in down payment. You have to meet the medium income range. Let's say you're a household of one, because they look at the total household income. Even if I had my son living with me and he's 27, they would look at his income with me trying to qualify for this program too. But for a $40,000 down payment program, if you make 80% medium income for a house of one is $46,800. If you make that or less, you could qualify for that $40,000 down payment. That's across North Carolina. They also have an $8,000 down payment. They have an MCC credit program, which could also give you some down payment assistance. I know here in Charlotte, and I'm certainly sure in Wake County and in Gifford County, other places, They have a great program that is called Community Heroes. That is if you are above the 80%, meaning you could get a $30,000 down payment and you could go up to a $300,000 house if you make that medium income. And if you just Google your income, that'll help you. But the biggest factor is get with a good lender who knows down payment programs. I used to be a loan officer. Yeah, I know, jack of trades, done it all. But anyway, the biggest factor is get with people who know what they're doing. Always ask a person, have you been doing that for a year? Have you been doing that type of program and how has it changed? You are the one buying that loan for them. You are the one hiring a real estate broker. So you need that wisdom. You need someone who knows what they're doing to help you not know everything, but get you to the right people. So, because that loan, like I said, you're buying that from the lender to buy your house. So there's also, when we talked about credit score, and okay, you stop me because I love to talk, but you need to have at minimum a middle score. Now keep in mind it's TransUnion, Equifax, and Experian, not the average, but the one number that falls in the middle. That's your mid score. That needs to be at least a 640 for most down payment programs. And of course, if you are a veteran for a VA loan, you can go down to 620, but strive to be above 640 because it costs you in mortgage insurance. The difference with an FHA loan and a conventional loan, because those are the two types of loans that you're going to be trying to obtain. And then the down payment program rolls under or overlays one of those types of loans. Of course, what you have as state employees is more of a portfolio loan. Like some other lenders may have a portfolio program, which means they hold it within their industry and don't sell it on the secondary market. So neither here nor there, but the whole point is get a 640 credit score or better. In fact, the higher it is, like I said, the better it is. Try to attain 680 if you can. I believe in being as debt-free as possible, but you must have credit in order to have a credit score. Anyone who comes to me logically under a 600 is because they technically don't have credit. I can tell that right offhand. And you need to build it from that point. So know strategically how to do it. I remember my husband and I were buying a house several years ago, and the loan officer, I still work with him today because he knows the ins and outs of so much. But he said, Keena, I need for you to go pay this credit card down to $12. $12, not pay it off, but $12, because if I can get that next 11 points, it's going to do phenomenally well for your credit score. Well, and of course, I paid it the $12, sent him the statement that said it was paid to $12, and they did a rapid rescore like that to get me to another level so that it saved me money. That's why I hire certain people to, work with me, because I need them to show me how to save money, not take my money.
Yep.
So when you are starting to do this, get your credit scores, know what kind of debts you'll have, pay those debts off. Most of the lenders have an in-house credit enhancement tool, and it's better if you can go to them and they tell you what to do and have it to where you can do it, and then they can do a rapid rescore and get your score updated within like 48 to 72 hours. Instead of going to a credit repair company that just opened up yesterday that wants you to pay $100 a month and $149 to get started. I'm not knocking them, but you need to know who you're sending your money to, because it takes the credit agencies, they have up to 45 days to update your credit reports. That's too long, especially in a market like what we are, where a house hits the market and it's under contract, but before it gets dinner time. So that team that you employ or hire is essential to helping you get to the next level to get your house and get it for the best price. So keep in mind, minimum credit score, no matter what lender tells you, is 640. but you want to strive to have at least a 660 or 680. If you can get up to a 740, you can do anything almost with these lenders. So, sorry, rambling.
All right, you about to say something, Joe?
Yeah, I'll add, I don't think we mentioned, but there are also two government loans, VA or Veteran Affairs, VA loans and USDA loans, which are 0% down payment.
Yeah, those are great.
But they do have their own requirements. Obviously for VA, you have to be a veteran, and USDA, you have to go on their website and see what eligible areas are for USDA loans. And so that information is online as far as what areas. Usually they're rural areas, but you'll be surprised. There's some areas that aren't really considered rural, but they are towards USDA.
Yeah, and you can check each and individual address on USDA, which is great.
Mhm.
That's how you can know if it falls within that zero down. Great program.
And also I think the 203K, right, is something that can be utilized if you find a property that you may want to put repairs in, and that 203K loan, they'll lend you the money to purchase it, as well as a repair costs. I'm not sure all the requirements. I know that you have to live in it. It has to be your primary residence. You got to provide like repair schedules and things of that nature before they release the money. But that's a good product to use if you qualify, if you find a property that needs some renovations, and you
especially in North Carolina. In North Carolina, where the sellers don't have to make repairs, it's ideal. That 203K loan is a FHA product, and the easier part of that is to go up to 35,000 in repairs. And if you go above that, that is a more rigorous type loan. But let's say you go in, which most of our clientele, we want it to be easy for them. You go in, and if you need paint and you need carpet, those are easy things. New appliances, that's exactly what you can put into a 203K loan. We did them all the time when we had HUD foreclosures out here. You're able to, as long as there are no structural issues, you can get pretty much everything in the upfit of that property.
Right.
It just may take 45 days to close, because once you go through inspections, you get the contractor to itemize the repair costs. And once the house closes, then the repairs are done. You can't do any repairs until it closes, but that contractor itemizes the list. It must appraise at the as-is value for now, and then the estimated repairs on top of that, it must appraise for that additional amount. So I'm doing one right now, and it's working out really well for a house that, once we can get some flooring and paint on that, it will be an awesome product. So that's a great option to throw out there.
So one thing that just from hearing you guys talk, that kind of came to my mind was, in this market, and sometimes buyers are posed with the question on, do I go new construction? Do I find something that is already built and move into? What are some of the pros and cons of going new construction? I'll start with you, Joe.
So one biggest thing depends on your timeline, right? So most new constructions have a 6 to 8 month build time. You can get inventory homes if they're available homes, but if you want to build your own home, it's going to take 6 to 8 months. Now, can you wait that long? It just depends on your timeline. As opposed to resold, you can buy a home essentially 30 to 45 days from the time of contract. So that's one of the, and people, y'all can also chime in and help me out, but that's one of the biggest differences as far as new construction and resold. We're seeing, just because in Raleigh and Charlotte, mostly all of North Carolina, the inventory is very low. Meaning there's not a lot of homes on the market as it is. So it's the demand is high, and the resale market is very aggressive. You're gonna be putting in offers of multiple homes before you actually get a home. So if you if you do, if you're looking for a resale home, there is, well, actually, if you're looking at a new construction home, another advantage is the warranties, and it's a new home. So you do have warranties that come with the home, as opposed to resold, you'd have to buy your own warranty, or just come out of pocket with the repairs. That's just on the top of my head. Someone else can chime in and I'll probably add some more.
Joe, I'll piggyback off of that too. To your point, the resale homes, they're drawing multiple offers. You're having to go over asking price, $10,000, $15,000. I've had clients write $20,000 over asking, we still not get the property. Don't say that to be scary, but that's just a real story, and just trying to be blunt with someone. So if you're doing that for 6 and 7 months, it can be really tiresome. To Joe's point, if you can live with the new construction build, at least you're in there. Like, at least you got the crib, and now you're just kind of waiting for that to come together. One of the biggest things I'll say though with new construction, is because I to be honest with you, I used to try to stay away from new construction altogether, just because I didn't know what the market was going to be doing. But what's been happening in Charlotte, and I'm pretty sure it's pretty consistent in multiple markets, is when you're looking at new construction, ask the question to the builder, where are they at in the process? Where are they at in the phase? So every 3 to 4 homes in Charlotte in a new construction, a builder's going to go up prices $3,000 to $5,000, sometimes even more than that. Meaning, so if you get a neighborhood and there's 30 homes in that neighborhood, the first 3 homes might sell at $200,000. Well, after those first 3 have sold, home 4, 5, and 6 are going to sell for $205. Home 6, 7, 8 are going to sell for $210. And you guys can keep going in that path. So if you're getting there early, right, you could be the guy to buy a $200,000 crib, and now it's those same comps are going for $240,000 6, 7 months later, and you wrote all that equity up. Also, too, lots of times you can use their lender, and they'll give you some of those closing cost credits, closing costs that you're not getting in the resale market right now, just because sellers don't have to give it to you. It's just so competitive. The bad part of that, the con I would say on that is if you're coming into a new construction neighborhood at the very end, because the same way that the first person's benefiting, that last person is kind of, first in, first out, you're kind of being affected. If you're coming into that same neighborhood and now paying $250,000 for the home because you're buying home number 30, and everybody else has either got their homes at 240, 230s, 220s, in my opinion, you're walking into potentially negative equity. I don't want to say the word negative equity because that is all substantial and to everybody's own experience in their own different markets. But it's very important if you want to go new construction because you like all the new things and like what comes with it, that you understand the base price of new construction. You understand that when you go in there, if you want upgrades or you want these simple things, that the builder's probably going to tax you for it. They're going to charge you a lot more than you usually would have to pay. It's very important that you work with a realtor. You ask them the question of, hey, what are some things that I can do off market or after this deal is completed? Can I change that faucet out? Can I change that light fixture out? Because maybe the builder might charge you $300 to install this new fan, and you can go to Lowe's and buy any fan you want to for $300, and have somebody install it. So it's just very important to get pricing in new construction, see what place you're coming in at, right? And not to say if you buy house number 30, hey, if you're going to be in that house 30 years, it's fine. But if you're talking about a 3 to 5 year play, like a lot of us try, a lot of young people like how we think, then you're trying to make sure you're getting in the middle or the start of when they broke ground in that new construction site.
Yep. Appreciate the info.
That if you're talking about investments too, that's an awesome point that you made there, Calvin, because from an investment mindset, me and a couple of partners are targeting new construction to go in when they first start and grabbing those houses. I may be able to buy one because they do track now per se how many investors are coming in and buying the properties because they don't want it to turn into a real rental community. But if you can get in at that first start, specifically if you're buying your own your home to live in, I helped a young lady, 25 years old, and she bought a house, sold it the next year, and walked away with over $60,000. She's now on her second house with me. And this is like the second year we're working together. And she's now going to get another house. Well, she's actually in a townhome, but she's now ready to buy an investment property. She's just that savvy. But when you start thinking about maximizing your ability to buy as an owner occupant, do that now, because that's how you can cure student loans and other debt if you decide to sell it. I mean, I'm not tooting my own horn, but I did that 2 years ago with a townhome that I bought, and I got in within the first week, and I sold it 2 years later, and I made 6 figures off that bad boy. And that's how you do it. And it's not like, I mean, I had expenses wrapped up in that, like my down payment and stuff, but I'm encouraging each and every person on this line. If you don't own a home, whether you want to live in that house or not, buy your first house, because we are in a state that everybody is trying to come to. Raleigh may have a little higher cost of living, but North Carolina it's a humpback state where people who used to go to Florida to retire are actually coming to North Carolina. People who are living up north in DC and West California and all these other higher end places, our cost of living is still so wonderful. They're coming here. That's why rent is like it is, and you see apartments coming out of the ground every week. That's why the inventory is so low. Our housing affordability index is going low, which means it's less affordable. Our values and our prices are going high. You guys, whatever your age is, I mean, I'm sitting here at 51 years old and I'm still trying to figure it out, but you guys should be getting your first house, because wherever your life takes you, it will definitely pay off with getting income from rent or selling it and making money off of it. I have people who are selling now because they want to get that money to do something else with, but I know the values are going to continue to thrive and you're going to continue to make money. Just like people jumped on that stock with GameStop, you got to be ready. This is free money right now, where in my age, it was okay. And we thought 6% was great for an interest rate. You guys are looking at 2.9% or less. Take advantage of that. If you are renting, knock yourself in the head and say, why am I paying somebody else's rent? If I can get the right person to show me how to do this, let me buy my first house and make that happen for yourself. There is money coming. There's money already out here as far as down payment assistance for first-time home buyers. A first-time home buyer is classified as a person who hasn't owned a house for the last 3 years. So if that's the case, I saw something that says, is refinance worth it? Honey, if you have a interest rate of 4% or 3.5%, yes, go refi, because you cannot beat the rate that you'd probably get today.
Again,
I'm sorry.
Cut you off real. So I know we're getting close to our time, and I know we got a few questions. So I'm gonna go in the chat and get some of these questions answered. So one of the questions was, what are some things to look out for to know that your lender is really good? Any red flags?
You talked about that 203K product.
Mm-hmm.
No, not many people can do that well. You need to interview that lender and say, how many of these have you done in the last 24 months? And if they tell you no, you need to go find somebody else. If it's an FHA or a VA, those guidelines are pretty consistent and most loan officers can do that. But you need to ask people what their experience is like, especially if you're trying to do down payment money, because you got to have somebody who knows what they're doing. I've been with the same 2 people who do down payment because they've been so consistent with being able to get my clients to close. Just interview them.
Yeah, customer service, like how they treat you, when you call them, or if you get a recommendation, definitely you're buying their product. They're at service to you. So make sure they're treating you, how they treated you on the front end, that's how they're going to treat you throughout the whole process. So making sure they have experience and great customer service. And usually can tell, off the first, couple conversations.
Yep. Yeah, and then also how long it may take them to close your loan, especially in this market, trying to be competitive. If it takes them a long time to approve and close your loan, you may want to try to find somebody else that can lend you that money. Another question that we have, So for the panelists that may have utilized or may have any knowledge about it, could you describe the pros and cons of utilizing a property management company to manage your rentals?
I'll speak on that a little bit. The pros is obviously you're hands off, right? They're handling everything. If something is to happen with the tenant, they're supposed to be giving you a call and kind of letting you know what's going on, but they're the actual ones taking the course of action. If you're out of state, it's a really good thing to do because you can't go and touch your rental overnight, or it's not overnight, excuse me, in 30 minutes. It might not be in driving distance, et cetera. So you want to have somebody who can call, and if there's a flood or something or an emergency, like the heat went out, something that you can't afford to go overnight, you have a tenant and you need to handle it right then. Just to have a point of contact or kind of an assistant who can escalate and take care of that. But what I do also tell people, and it's kind of shooting myself in the foot, I've had friends ask me like to manage their rental properties here in Charlotte. It's not really that hard. And I don't say it's not that hard because it really all depends on the tenant. You can do a really good job of masking your tenant. It's a lot of programs out there to mask your tenant, to not just look at their credit score, but you can do your own due diligence, like going on Facebook and stuff like that, and just typing in their name, seeing like, you know, how they talk or not necessarily how they look, because you can't discriminate, right? But you can see, you know, sometimes people put it out there exactly who they are, and you know how people do on social media. But I would say if you have a rental or two rentals and you're nearby, you try to manage it yourself. And I just challenge you to do so, because it's really not that hard. Specifically, if you have a tenant that you know, like a family member or a friend, I mean, most likely they're going to take care of your crib, especially if you have a standing relationship with them beforehand. I've had clients who've done their own rentals and they love it. And I mean, it's just so easy to do. Really, the person's paying you the money and you're paying your mortgage, and that's pretty much it. If something happens, of course, and you're in Charlotte, or I can drive to my rental property, I can call myself. I can call Pete My Gas and tell them that, hey, that something's wrong. I can call the repairman to say if something's broken or something's leaking. If you get over 2 or 3, it might be better for you to take a property management. But if you're at 1 or 2, it's just good for you to not only save money, but you to also kind of get experience to see like, okay, what happens? I think it's very important too, to know, even if you're not the property manager, how's that property manager working my property? And if you do your own to start off, you'll have an idea of what they're doing, you know, as you blow up, and because you want to just know how to do it yourself too.
Yeah, that way you save the most money. But I will tell you that most larger property management companies make a good deal of their money and profit off of the repair costs. And when you do an agreement with the property management company, you need to read that in fine definition, because they don't have to call you as a landlord if an expense is at a certain amount. So they just go out and they do that. I know I've seen people with who've had property managers, and they got a surprise when they only got half of their rent for that month as the owner. So you need to be in control of what they're doing. One thing, because we've done property management for years, and one thing that I can tell you, the best thing you need is an attorney who will help you evict someone who is not paying the rent. Other than that, like Calvin said, you can do a lot of that yourself. There are online systems to where you can do background checks. We always had a policy that, because we were coming through the recession, that we would look at people and not do people with evictions or foreclosures. But if you had credit issues because of medical stuff, we just do double deposits. And we would manage those things ourselves because we had the security of those larger deposits, and we helped the family who wanted to come and who had a great rental history, but had bad credit. You get that a lot too. But try to manage it yourself or research those things.
Good. So we got a few more questions. I know we're at time, but if everyone has a few more minutes and want to stay on to hear the rest of the questions, then we'll keep going. So the next question is around any suggestions on selling while the market is low right now? Hold on or sell? So this
Take
is
that money if you want that money.
Yeah. So it's a tough decision, but I'll let Calvin. You want to talk on this a little bit?
Yeah, I'll speak on it. I honestly think even though it's really nowhere to go necessarily, you kind of got to make the money. One, you just don't know. I think we take for granted, like we sometimes act like we're genius, like we know what's going to happen next, right? And we're just assuming, it's an assumption to say that this thing is going to continue to go in a certain direction. it's an assumption to not take like sometimes the profit or that you've already made as a blessing and kind of move it forward. And then two, really you blowing up that profit and what you can turn it into. Can you go and get yourself another property and or a rental property? If you're making, and then this is happening in real life, like people are making 6 figures on the sale of their home that they bought 5-10 years ago. If we can take that and bring 20% as a down payment to our next property and then go out and get us a 20% rental property, that's just a much better use of the money. And then we're also taking advantage, as Akenna said earlier, these historically low rates. I want to get all my clients back in. So I want you to take advantage of the money, right? But I want to get them back in as soon as possible to take advantage of these rates, because when these rates do go back up, it's going to be more expensive for these kind of your dream home, if you will. But I just don't, I don't think it's fair. I don't think you are smart to always to make any assumptions. I think you kind of sometimes just have to like take God's blessing when he puts it right there in front of you. And specifically with the market like this, like I think I was reading an article last week and the market went up like 9% last year. So if you had a $300,000 property, you went up $27,000. And I mean, I talk to people like real life. Hey, can you save $27,000 from your day-to-day job if you're paying your bills, you know, and you actually have kids or you have other things going on? It's just a way to tap into some equity or some income to pay off debt and just to live, get closer to being debt free. And then again, you're not like walking away. You're going to go back and double back down and get yourself back into a property to hopefully ride that back up.
Good, appreciate it. And the last question that we have is, I've heard the current administration is looking to potentially pass a bill that will allow first-time home buyers up to $15K for a down payment. Have you all heard any updates regarding this?
I haven't seen that it's passed, but that's another thing that's coming through. There are grants that come across constantly. You've got Wells Fargo, who's been in trouble with their lending practices and stuff, and they've got things out there. Bank of America's got different stuff. So the key is going to be qualifying for whatever down payment money is going to be out there, because it's no different than what's out there right now to some degree. You have to be able to meet the criteria. And like we were saying, if you're a household of one and you're required to do the 80% medium income, you could make $46,800 and qualify for like a $30,000 loan or a $40,000 loan. It is key to talk with a lender who can specialize in down payment programs to help you with that. But there are options out there. And I say try to take advantage with the right person to help connect you to those resources.
Perfect, thank you. All right, so we've come to the end of our program. Definitely appreciate everyone for joining and being part of the conversation. This is the first of many, and we'll provide information on when we have another one. And we would love to hear from you guys on kind of information and the things that you guys want to hear and talk about as we begin to continue these series and touch on the different regions. Right now, we're showing the contact information. So if you still have questions that didn't get answered, or if you want to get in contact with any of us in regarding real estate, purchasing a home in the different areas, you can take down our contact information and reach out to us if you have questions or want to get started. With myself being in Charlotte and Greensboro, Akenna in Charlotte and South Carolina, Joe in Raleigh, Durham area, and then Calvin in Charlotte. All right.
Yeah.
You guys have any last comments before we close? And thank you guys for participating. I appreciate you taking the time out to be a part of the conversation and giving your insight and knowledge to everyone. You gave a wealth of knowledge that I think will be very beneficial to everyone. And look forward to working with you all again and providing some more information.
Thank you for putting it together.
Yeah. Thank you.
And thank you for everyone for joining.
All right.
All right,
Have
let's
a good
go
evening.
buy some houses.
Yeah.
Yeah, let's go buy some houses. Hey guys.